Hey, what's going on, guys? And welcome back to my channel. Today I'm talking about a few different subscriber questions and comments. The first one is from K97 about a week ago. He said, "Let's see your updated M1 portfolios." Of course, I have to show you my M1 finance portfolios. What kind of person would I be if I didn't? And the other one came from Leroy Taylor about an hour ago as of filming this video. He or she said, "Hello, I have a silly question. I use M1 Finance and I did a ton of research and hold about 40 holdings with my 1,000 in the account. Do you think that is too many holdings?" You can't see it from here, but he basically asked if his M1 Finance portfolio is too large. So I'll be going over both of those comments in this video. So first I want to address K97's comment of my updated M1 Finance portfolios. If you guys couldn't tell from the title, I have 3 M1 Finance portfolios now, and I realize that might seem a bit drastic to some, but honestly, I'm still young. I'm still figuring out what kind of investor that I want to be. I think I might just keep Robinhood for trading stocks and M1 Finance for long-term investing. Basically, never touch the stocks on M1 Finance and just really keep things like high dividend stocks, dividend growth stocks, basically anything that would really benefit from the DRIP program that M1 Finance can provide, especially fractional shares, dividend reinvestments, all that type of stuff, automatic purchases. M1 Finance can do that so much better than Robinhood, but Robinhood is so much better for swing trading. So why not keep them completely separate and avoid the need of have to purchase the same companies in different ones? There might be some exceptions for sure, but for the most part, I want to have 2 different strategies. So that's what I'm focusing on right now. I have, in fact, about 3, as I mentioned, 3 different accounts. So I liquidated my first one, which is high savings. This was my main account. I had a few different types of strategies here. And so what I've done is I'm going ahead and going to replace my high savings account with 3 other accounts. So the first one is Rhino, the second one is Narwhal, and the third one is Unicorn. So they're all creatures that have a horn. I really like the theme of that, and they all have their own personalities. So I'm going to go through basically each of them. So first I want to talk about Rhino. Rhino has a portfolio which is called Element in it, and so it's called Element because there's just basically 5 different stocks, 5 basic food groups, 5 basic elements, that kind of thing. I wanted to keep it pretty simple and pretty primitive. So this is what I would consider to be defensive growth. These are all stocks that grow a lot in terms of capital appreciation, but actually don't take that much of a hit and aren't as volatile as other stocks that can be found on the S&P 500 or the NASDAQ. So it's the best of both worlds with this. I called it Rhino because I consider it to be, stable, tough, at the same time aggressive like a rhino. The other portfolio that I have is called Narwhal. So this is one that I consider a lot more experimental. I pretty much just have my gold miners portfolio in Narwhal. Narwhal, I'm killing it on. I have about a gain of 21.78%, and this thing hasn't even been around for a year now. So pretty much in maybe I want to say 8 months or something like that, I'm up 21%. As you guys know, gold has been doing pretty well recently, and so as a result, my account is doing pretty well. And it's really just a few winners that are really leading the way, like Newmont, Goldfields, Anglo Gold, etc. And then I have a couple massive gainers and that kind of thing. I do have some losers, but the gainers really outweigh the losers. And so this is my Narwhal, which I consider to be a little bit more, I guess, mythical than the rest of these. I mean, I guess it's hard to compare Narwhal with the Unicorn, but Narwhal seemed a little bit more, hidden. It's more in the sea and that kind of thing. So the final and favorite portfolio on my list is Unicorn. So within Unicorn, I have about $1,027. Next week, I plan on putting another couple $1,000s, and I do plan on putting the majority of my money into this one versus the other 2. So this one is actually somewhat of a retirement account. It's not technically a Roth IRA. It is a taxable account, and I don't get the benefits of a traditional, retirement account. But the reason why I address it that way is because I don't plan on touching this one for a long time, and the stocks that I picked are stocks that I feel good about over the next 30 years and that kind of thing. So let's take a closer look at Unicorn in terms of performance. So over the past 5 years, you'll see that it's gone up about 27%. But I think that's a little bit misleading. If we click on this link here, we'll go to this tab, and what it says is that M1 does not rebalance or invest dividends in the performance. The chart only measures the capital gains and expense ratio over that period. So basically, it takes the gains, subtracts the expense ratio, and that's how you get your performance. But for something that has such a massive dividend yield, like 4.5%, that makes a huge difference over the long run. So obviously expect this number to be boosted up, and yeah, look forward to seeing where it goes. Let's go ahead and take a look at the slices within Unicorn. So I do have two. I have dividend growth and monthly high dividend. So the monthly high dividend one is pretty self-explanatory, and I do plan on making a more in-depth video of Unicorn in particular. But just as a brief overview, I have two multi-asset bond funds. They pay a massive amount. I have two, different capital and investment corporations. These deal with assets such as real estate and credit. I have SPHD, and I have four monthly dividend payers that all increase their dividends almost every single year, with the exception of Stag Industrial. And then on my dividend growth pie, I have about 20 holdings. So this, performance is a lot stronger. The 20 holdings give me a yield of 2.93%. There is no expense ratio because there's no funds within this pie. And all of these I've taken a long look at and decided, like, how do I feel about this company over the next maybe 20 or 30 years? You won't find something like Kellogg's or Kraft Heinz or General Mills, things like that. I was a little bit more picky with the CPG companies in particular. So as I said, I will make a more in-depth video about each of these holdings. I didn't want to get this video to get too long. Really just wanted to emphasize that I have 3 different M1 Finance accounts now, and one of them has about 30 holdings. So to answer your question, Leroy, 40 holdings is not all that much, and I love dividend growth companies. As I mentioned, my dividend growth pie pays a 2.9% yield, and my monthly high dividend pie pays a 7% yield, where a lot of these actually increase their dividends. So I love dividend growth. A huge fan of PPC Ian. Some people watch Friends to go to sleep, Friends on Netflix, but I actually watch PPC Ian, love his content. And so I eventually caved in and decided to make more of a long-term dividend growth style of investing. So yeah, that's going to wrap it up for my M1 Finance updates. Hope you guys enjoy this video, and I'll see you guys in the next one.